actually quote another Buffett saying from, Eric's really good at that, is you have to be greedy when people are fearful, and you have to be fearful when people are greedy. And that's why you hire a manager. That's why you hire a financial advisor, whether it's at Wells Fargo or somewhere else, is we take a clinical look at this. And we try to take emotion out of the process. And sometimes those calls are hard. Sometimes our clients get a call when things are at their worst, and we're going to do something that they don't want to do, and we're going to be buying. Sometimes we're going to call clients, and when things are at their best, and saying, things are looking tough, your valuations are high, and so forth. And it's going to be counterintuitive to most clients, but it actually turns into the right thing to do. And I'm going to show you a lot about that process. We're thinking differently now. And I was walking down the street. I take these courses, the great courses online. You may see them advertised in airline magazines, and I was taking one on cognitive behavioral theory, of all things. And this came upon me a couple weeks ago. It's by Charles Darwin. It's not the strongest of the species that survives, nor the most intelligent. It's the one most adaptable to change. And now is a really good time to change. Now is a good time to think about managing assets in a little different framework, and we're going to talk about that. So the title of this is The 4 Steps to Success. The first one will be start with a plan. Eric touched on that. We're going to go next to how to construct your portfolio. Third, globalizing your portfolio. Eric also teed me up in that. And then how to maintain alignment to your plan. So let's get to the meat of this. I want to start with a plan. And here's some statistics that were just surprising. We do a lot of work with focus groups, and we do a lot of work with what's out there. I may even defer some of this to my partner Scott here, who heads our planning area. And I'm going to tell you how important this is, because when you look at the population, these are, let's just take it, these are the 20s, 30s, 40s, and 50s. Estimate how much income you would need each month in retirement. Only 47% of the population age 55 and up has actually done this. And this gets a little scary. Prepared a formal written financial plan for retirement. 13% of the people over 55 years old have actually done a plan, have actually committed to numbers. They don't know. And that's what Scott and his team do. Some great addition to our clients within planning. And so how are we going to plan? Well, we have a process. And this is the most interesting process. That first one is define major life goals, ideal and acceptable goals, and prioritize goals. And when I got to Wells Fargo 5 years ago, I thought this was the cheesiest thing I've ever seen. And we use these things called discovery cards. It turns out to be the best thing we can do, because we'll take a situation where a husband and a wife come in, and we hand them both a pack of these cards. And what these cards are, what are your goals? They might be transition of business, leverage or manage debt, give to charitable causes, fund educational goals. There's a number of these. And then we hand the husband a stack, we hand the wife a stack, and they prioritize things. And what the most amazing part of it is, never have we seen them prioritize things in the same way. And the great part about this is it gets them talking. And every time they walk out of that meeting, Mike, we've never done this. We've never talked about this. Why don't you give us a week or two, and then we'll have a second meeting, and we'll come back with something more solid. That gets us excited about doing this planning process, and you can see how important that is. The second part of this is you go to your investment professional. We have software where we can set up a plan. We can stress test your goals. This is great, because things will get rough out there. I've been doing this about 33 years. I've seen 3 bear markets. The last correction, we define a bear market as top to bottom 20%. We define a correction, top to bottom, down 10%. And so this last correction we had earlier this year, I called our research department. I said, since 1985, how many corrections have I seen? Young guy got back to me, 26. And so right now, because the sun is shining, as Eric mentioned, it's a really good time to stress test what you're doing. And that's where the planning process comes in. We want to monitor progress, and then talk to our clients a couple times a year to see if there's new goals or priorities. And returns will jump around. It's hard to really predict returns, but what we can do is predict risk and manage risk. And risk is found in a number of different ways. Most people think of it strictly as commodity market, bond market, or equity market sensitivity, the probability that things go up, down, but risk is much more than that. There's transparency risk, there's liquidity risk, risk that the money's not there when you need it. We've seen leverage risk rear its ugly head back in 2007, 2008, where people were over their head in debt and had to put back their homes to the bank or their cars. That's something you certainly have to manage. And then, as Eric said, all those things out there, that's event risk. And that's important because people ask us, what happens if North Korea does something bad? What happens if Russia comes to war with us? Well, the obvious answer is don't put all your assets in one place. If you're worried about the debt and you're worried about inflation, don't have all dollar-denominated investments. If you're worried about what's happening in Asia, don't have all your assets there. It's diversification, and it's using this way of managing risk to diversify and spread your bets around the world. And at the end of the day, before we do anything, we form an investment policy statement for our clients. Those are the rules of the road. And most people back in the 80s would be concerned, have I beaten the market? That is not the question you should ask. The question you should ask is, are my assets going to be able to fulfill my goals? And that's what the investment policy statement does. So let's get to the second part, and that's constructing your portfolio, which is something near and dear to my heart because, again, I've been in the investment business a long time. Over the years, we've done research projects, and we've looked at the difference in portfolios. Why does your portfolio differ from your portfolio and differ from your portfolio in regards to return? And our research has concluded a number of different things. The first thing that differs, that makes clients' return different, is something we call strategic asset allocation. It's the percentage of stocks, bonds, real estate, cash, and so forth in your portfolio. The second thing is what we call tactical asset allocation. And on the margin, we will do this and start moving assets from those areas we think could be overvalued, could present risk, to those areas which could be undervalued. So one thing we're doing right now is you want to look at the high yield bond market. Ordinarily, high yield bonds yield about 4% over and above treasuries, so you're getting paid to take that kind of risk. We've seen that spread between high yield and treasuries compress a little bit. Doesn't look like a place we want to put a lot of assets right now, so we will take assets out of there and put them in other areas. What people are mostly concerned about, what the media is mostly concerned about, that's security selection, and then other, that 6%. Has to do with things like fees and so forth. So I want everybody to concentrate, first of all, on that strategic asset allocation. Eric also mentioned the areas you want to invest in. We talk to our clients about a 4-asset class portfolio. It would be global equities, global fixed income, real assets, which would include commodities, real estate, infrastructure right now, and then I'm going to talk a little bit about alternative investments. At the end of the day, our larger portfolios that enable us to take advantage of all these asset classes contain 24 different asset classes. And you'll see the media will have you concentrate strictly on large cap stock. What's the stock market doing? And I'm going to show you that's just one of 24 asset classes we have the ability to invest in. This is a chart I'm going to refer to, and us investment guys refer to all the time. It's risk versus return. So as you move on this axis to the right, those are riskier situations or riskier portfolios. As you move on the y-axis and you move that up, that's return. So our job, if we're doing it properly, is to get you the most amount of return per unit of risk. So if this was a map of the United States, you want to be up here by Oregon, you want to be up here by Washington, and you want to stay away from Florida. down here. So when I got into this business, back in the Stone Age, I had basically two asset classes to work with, stocks and bonds. Unless you were General Motors pension fund and you had $1 billion, you couldn't access some of these things we can access now. So we would have the large cap stock portfolio, a bond portfolio, and then gradations of risk in between. So later in my career, we said, what happens if we add commodities or real assets? Well, that takes that line and moves it up and to the left. That's what we want. And later, as rules change, as our ability to access alternative investments have changed, we continue to take that line and move it up and to the left, which is what we're supposed to do. I'm going to get into our portfolios and how we're changing and how we're thinking about these right now, and why are we doing this. Number one, there's a potential for greater return. Tax efficiencies, satellite investments, I'll talk about that. We're going to understand what drives your portfolios. We're going to understand where we want our clients to spend their money. We want to budget that. Where we should be passive, meaning just in an index fund, and where we should be active. And then we want to be very flexible with tax management and things like that. This is a very complicated, don't worry about it, but these are the 21 asset classes. And here's where we are sitting right now. I talked about strategic asset allocation. So if we take a mid-risk portfolio, moderate growth in income, we will do this at any one time, and if you're interested in this, let your advisor know. We have a monthly asset allocation report we come out with that details this. If you need to get to bed some night and you can't sleep, you certainly can read this. So there's the strategic asset allocation, our tactical shifts, and so forth. So how do we do this? We have to admit that there are good places to spend your money and good places to take risk, and then not so good places. So the first thing we're going to look at is our core approach. This is going to be the basics of our client's portfolio, basically U.S. stocks and bonds, what I managed 25 years ago. And we've understood something over the years, that there's a lot of smart money doing the same exact thing. In 2000, the market starts rolling over. I was a growth stock manager, managing stocks like, at the time, JDS Uniphase, Cisco Systems, Sun Microsystems, a lot of companies that no longer exist. And I'll tell you, there's nothing worse or more useless than a growth stock manager in a bear market. March 23rd of that year, the market rolls over. We had a down 49% 3-year bear market, where the average tech stock was down 82%. So I thought to myself, as somebody put a report of General Electric on my desk, what am I going to do with General Electric that the other 50,000 guys reading this report can't do? Not much. Because I wasn't in business to manage wealth, I was in business to be good enough so people paid me to manage their wealth. And it came to me a couple months later, intermediation of alternative investments. What does that mean? The more complex the deal, the more I can give clients a better return per unit of risk, the more they'll pay me. And what I found out is there's a lot of times in these markets, it's better off just to be passive. Just go to an index fund. Don't pay a lot of money for this, because there's too many people doing the same thing. And so the second ring we have with our clients is some things that we can add value to their portfolios, where we think they should pay. Things like option strategies, tax loss harvesting. Now that's interesting, because believe it or not, when assets go down, that loss actually has a value. As you pay the government a certain amount of money when assets go up and you sell them in the way of capital gains, you can offset those with capital losses. And that's important to do that throughout the management of your portfolio. Things like a unique active equity, looking at those areas that have less people chasing the same deals. And then the third ring we have is what we would call the satellite ring. A lot of these will have something called an illiquidity premium. That's what you grasp from the market for locking your money up for a certain amount of time. We'll get to that in a little bit more detail in a second. There's also things out there that aren't widely understood as U.S. stocks and bonds, like master limited partnership real estate. emerging and frontier markets. You may want to think about not just emerging markets, but other frontier markets such as Africa, which 20 or 30 years ago could turn into the next emerging market. That gets us excited. So here's another complicated chart. I'm just going to show this to you for a second. We have the core, we have the enhanced core, and we have the satellite allocation. So the core, those are going to be our stocks and bonds. We're going to have a bias towards passive management, understanding we don't want to spend a lot of our clients' money to try to beat a market that's very difficult to beat. They're going to talk to you about in a second that it's probably a good time to move from passive to a little bit more active, and I'm going to show you why. Out here in enhanced core, we're going to have a tendency to be much more active, and then in our satellite allocation, pretty much all active with the exception of commodities at times. You have to understand we are managing wealth for private clients, and unlike most institutional clients, private clients pay taxes. So it's not just what you get in return pre-tax, it's what you get in return after tax. So we're very cognizant of taxes and asset placement. Where is it best to play? Is this best in a trust? Is this best in an IRA? Is it best in your foundation? These are things Scott and his team works with our clients on, and that's called asset placement, to get the highest net returns on an after-tax basis. Eric talked about your returns and holding cash, and I'm going to steal a story from him. Eric and I have an agreement now that he speaks first, because a lot of times I'll speak first and I'll steal his jokes and I leave him nothing when he does that. So that's the unwritten rule now, is I speak second. But let's take a look at cash yields in different areas of the world. We can see Australia is up to about 4.1%, 4.4%. This chart's a little dated. 3-month treasury bills now are at about 1.4, 1.5%. And so clients who hold a lot of cash because of this post-traumatic stress syndrome Eric talked about and think it's safe are actually wrong, because our inflation forecast is in the high 1s, low 2s right now. So you can put it in cash, but at the end of the year, on a real basis, you're losing about 1%. Eric tells a story where he's talking to a client, and he said, you should think about at least short-term bonds, at least a diversified portfolio. I said, Eric, but I'm safe. And he said, but you're losing money. And he said, Eric, but I'm losing it safely. And that's the hardest thing we do as wealth managers, is putting new money to work, is getting people to say, hey, I have cash. We should be thinking about diversifying outside of this. Let's switch to that third ring, and that's the alternative investment ring. And we'll talk about what we're doing there. There's something called private capital. I'm going to get into that and how important that is to start getting away from publicly traded stocks and bonds, because there's great opportunities if you're that type of investor that can take advantage of those. Things like real estate, I mentioned option strategies, and I'm going to talk a little bit about the much maligned hedge fund business. Hasn't been getting a lot of great press lately, but I'm going to show you why we include hedge funds in our clients' portfolios. So let's get to that public equity market I talked about. In 1995, the amount of stocks out there that gave us an opportunity to invest in was quite high. I want to say it was about 80, almost 9,000 stocks. If you fast forward, after the year 2000, 2001, there was a law that was passed called Sarbanes-Oxley. And what that did, just to sum it up, is directors and officers of all those companies were now personally liable for fraud under them. Think of WorldCom, think of Enron, think of other public traded companies that went down, and those managers were personally liable. If you take a look, because of that, the amount of publicly traded companies giving us an opportunity to invest in since 1996 has fallen about 46%. And so let's take a look and let's think about something about private equity and private traded companies. We have a program going on right now where we're talking to clients about, is it a good time to sell your business? Well, first of all, if in the planning stage, what Scott's team does is it usually takes a runway of about a year or two to think about these things on selling your business. But let's think about the environment. Eric talked about valuations. We have low interest rates. We have a lot of private equity money floating out there looking for deals. It's a great time to sell your business. And when I talk to our investment bankers, one of the valuation techniques they use is you have a private company, let's take a public traded proxy of this, and then the first thing we're going to do is take a discount because you can't trade it. Now let's think about your portfolio. There's always going to be a place in your portfolio for stocks, and I'm going to show you why you never want to get completely out of stocks or go all into stocks. That's going to be my last slide. So why are we paying 20-30% more for a publicly traded equity when we can buy a private one at a discount? That gets us very interested as professional investors. On top of that, when you look at the opportunity set of private companies versus public companies, the amount of public companies as a percent of all companies comes down to 0.1%. So you're leaving 99.9% of all investable opportunities on the table if you're not thinking of private companies. And what we've seen is we've been able to grasp that illiquidity premium. Over long periods of time, private equity has outperformed public equity because of that illiquidity premium. Let's take a look at what that looks like. So we have three bars here. The first one is that private equity I talked about. The second one are global equities, and the third are bonds or fixed income. Over the last 3 years, private equity has outperformed global equities by 6% a year. You can see the numbers for 5 years, you can see the number for 10 years, and if you're a long-term investor, this gets us really excited, 381% a year over and above public equities. How about that? So if we're not talking to our clients of this opportunity, we're not doing our job. And I want to tee up my partner Sean Cruzy, who's going to be talking next hour, is it next hour or next 2 hours, about some of these alternative investment ideas in a little more depth. The next thing I mentioned was active versus passive management. Let's go back to discuss the environment we've been in over the last 7-8 years. We are still coming out of that recession. Eric talked about post-traumatic stress syndrome. Well, I think the Fed had some of that too. And they've been doing what we call this grand experiment out there called quantitative easing, going out, buying securities, increasing the size of their balance sheet, and basically lowering interest rates to an artificial level. The outcome of that is that it's risen all boats. When you look at investments, there's two ways mainly to make money in the stock market, the most risky investments. That's cash flow to the investor. So those are companies in that index going out and selling stuff. And the second thing is as interest rates lower, prices go higher. So if we were going to go back and we were looking through the rearview mirror, the best thing would have been to just buy an index fund, because correlations amongst those investments were very tight, they were very high, there wasn't much to trade. We think we're going now into an area where active is going to be outperforming passive. I'll tell you another reason this gets us a little worried, and that's whenever you're an investment professional and you see a chart like this, it's called a parabolic curve. At the end of the day, there's only one outcome for this, and I will cite Dutch tulip bulbs in 1634, if anybody remembers that story, how everybody was trading tulip bulbs, and then at the end of the day, a couple of years later, it's like, what are we doing? Nobody's doing anything except trading tulip bulbs. The cobblers are out of business and so forth. There's only one way for that to end up, and that's to fall. But if you take a look from 2010 to 2012, the number of indexes defined by exchange-traded funds or passive investing quadrupled to 1,000. As of right now, there's almost 6,000 indexes. And if you look at the number of publicly traded stocks out there, in 1995, it was about 7,500. There's only about 4,200 publicly traded stocks. So when there's more indexes than publicly traded stocks, that gets us a little concerned. And that gives us a good signal to start moving from passive to active management. And I talked about correlations. This is the correlations of stocks within, that gives us things to trade. When we have one bar going really high relative to the other, that means stocks are doing one thing. So in 2013, all stocks were rising. This is the percent, about 95% had positive returns, only 5% had negative returns. Not a lot of things to trade out there. It's better to index there. Same thing in 14, a little bit better in 15. 16 started to get a little more even, and so far in 17 and 18, it's been a much better environment for stock pickers to go out and add value to our clients' portfolios and active management. The second thing we look at is the market cycle. Here's quickly is the amount of money that's gone into passive and active funds. As Eric said, what the problem is out there sometimes as a retail investor zigs when they should be zagging. We think that's what they're doing now and overloading passive inflows relative to active inflows, which is giving us an opportunity to go more into active management. And finally, on this level, you'll see we've ranked the best years to the worst years, all the way back to, I want to say, about 25 years. So 2013 was an excellent year. These dots here showed what active management did relative to passive management. When things are really, really good, honestly, we're going to go to that passive bias in our client's portfolio and not pay for active management. But you can see as things get tougher, active management does much better. So if in fact we are in the 7th or 8th inning of this economic cycle and this market expansion, it might be a good idea to think about active management. Let me switch gears here for a second and get into the hedge fund business. Over the last 6 or 7 years, because of this everything being highly correlated, it hasn't given hedge funds much to trade, and it's certainly underperformed stocks. But I want to put to our clients and talk about this, that hedge funds are not stocks. They are a different animal. And here's a chart I found extremely fascinating. These are the monthly returns of global stocks, going a pretty robust sample going back to 1990. Don't look at the numbers, just look at the colors. The red boxes represent those months where stocks were down more than 3%. And if you look at some times, some really fun times, 2008, September was down 12, October down 19, November down 6.5. It got pretty painful. And to sum this up, about 20% of all months in the stock market are down more than 3%. Now, what did the hedge fund business do? About 2%. So we want to use hedge funds not as much for return drivers, but for risk mitigators. And that's very important because you need some things in your portfolio, as Eric said, that are going to zig when everything else is zagging. Or putting protection on there by buying puts. There's a number of different things we can do in the derivative market, which helps out clients immensely. You know, the biggest thing I've seen in this business, as for clients losing money, is clients coming in with concentrated stock positions. You know, one way to get wealthy, you know, people ask me how to get wealthy, is have all your money in one investment. The same thing is how to get poor is have all your money in one investment. So when clients come in and they have concentrated, maybe low cost basis stock positions, we can take that risk out of that position in a what we call synthetic way, without having to sell it, and maybe put a what we call a costless collar on it, and which is just insurance, and it won't, you're giving up upside to get that downside protection. I want to finish up with a couple with an idea, and this is socially responsible investing. We do a lot of work with millennials and focus groups, and throughout our career, Eric's and mine, we're studying risk and return. Strictly, what can we offer clients in the way of return for the amount of risk they want to take? What we found out is millennials, and actually some older people now, it's not just what I'm getting on my money, it's what am I doing with my money. So we have a very specialized group that does an excellent job of socially responsible investing. Now, the issue is with SRI, socially responsible investing, it's in the eyes of the beholder. And my example, I would go back to the 80s and 90s. One of the best investments you could have actually was a cigarette business, Philip Morris, R.J. Reynolds. If you think about it, their clients were addicted to their products, literally. They could raise their prices, and they were very brand loyal. So we can probably agree that's not a very socially responsible company. One that we thought was very socially responsible was Ben & Jerry's, because they tithed. They gave 10% to charity. But if you look at the data, 6 times as many people die from heart disease, obesity, and its complications relative to cigarette smoking. So which one is socially responsible? Hard to say, it's in the eyes of the beholder. We have the ability to go with not just negative screening, companies we don't want to invest in, or just positive screening, companies we do want to invest in. So if this is something you or your clients are interested, let us know. Third, Eric talked about globalizing your portfolio and how important this is. I'm just going to talk fairly quickly on this. He talked about the global equity market. You can see the United States, it's about 53%, which means you're leaving 47% on the table, and some other great investable opportunities. Likewise, in the bond market, we have a much smaller percentage than the equity market of market cap and investable opportunities throughout the world, so you should really think about global investing. And then another reason is if you look at the growth rates of some of these areas, they look pretty darn attractive even after the Great Recession. It's much easier to make money in an economy that's growing 4, 5, 6% vis-a-vis an economy that's growing 1 or 2%. That growth rate will give you much better opportunities. So if you look at areas like emerging economies, we got on average, they're growing about 4% a year, and there's some economies out there that are growing much higher than that. That gives us a great opportunity. If you look at the United States, we're trying to get back to that 3% growth rate, which is what we've done since the end of World War II and the beginning of the Great Recession. It looks like tax reform is going to do that. But again, you shouldn't just invest your money locally, because there's so many great opportunities out there. And when you look at the unemployment rate in select developed countries such as the Eurozone, United Kingdom, Japan, there's all these great things going out there if you look at unemployment as a proxy for growth. Because as you get more growth in an economy, you're going to need more people to do the work. Okay, let's finish up with maintaining alignment to your plan. And this is where it gets difficult. This is where your investment advisor comes with a clinical approach. I love this chart because we can index $100,000 back to the year 2000. And it's good because this contains about 2 market cycles right now. You start at year 2000. If you go forward, we had 9/11, we had a war, we had a recession, we had that down 49% 3-year bear market. Going forward in 08, 09, we had the recession, again, another economic cycle. So this gives us some really robust data to study. And we have 4 different portfolios. You would think this portfolio would outperform everything, up 124%. That would be a portfolio of US stocks. But what happens if we added a little bit of bonds there? So we're going to put ourselves in a less risky place. Oh my goodness, we actually get about the same return with less risk. Again, that's what we want to do. What's going to happen if we add rebalancing? Meaning, every quarter, we put that back into 60-40. So if it goes into 65-35, we sell the winners and buy the losers. Look at what we do. Look at what we did. We went up from 125% to 146%. What happens in that 4 asset class portfolio, which has the best risk in the way of the lowest risk out of all those 4 portfolios, it's up almost 200%. Now, it's a little counterintuitive. How does that work? And I'll tell you exactly how it works. Here's an example. We have asset A and asset B. Both after 2 years did 30%, except asset A was up 30% that first year, was flat the second year. Asset B did exactly the opposite, was up 0 the first year, 30% the second year. So if we put a portfolio half A and half B, we're going to get 15, right? Just by definition. But what would happen is after that first year, this 30 up 30%, we rebalanced. And we sold our winner and bought our loser, after 2 years, we actually picked up an extra 2.25%. Just by being counterintuitive. And that's how that line, let's go back to the last slide, that's how that line is so much higher than the other ones. We continue to sell off our winners on the margin and buy our losers. This is the most, we call this the quilt chart, and it's just look at the colors. And we go back to 2002, and this is our return chart, and we rank each of those asset classes from best to worst. So you'll see in 2016, small cap did the best, up 21%, all the way down here, cash did 0.3%. What's a truism is you'll see the riskier asset classes will jump around. So small cap will be at the top, it'll be at the bottom. So what happens if we take these and put that in that 4 asset class portfolio, and what do those returns look like? Well, it's in a track here. What you're going to be is you're never going to be at the top, you're never going to be at the bottom. And that's what we are designed to do with our clients. We want to stop them from going through those whipsaws. So on average, from 02 to 2016, they clocked in about 7.3%. And those people that were just in U.S. large cap equity did 6.7%. So we're doing what we want to do. We're grasping more return and taking less risk. Now, if we take this chart and rank it by risk, this gets really interesting, where returns jump around quite a bit, risk doesn't. So you can see up here, cash alternatives are always at the top, the less risk. You can see the other less risky asset classes. And this is fascinating because we've been fighting this. Why am I in this portfolio of all these different asset classes when I could have been in stocks? Well, in this time frame, pretty good time frame, 2002 to 2016, U.S. large cap equities up 14.4%. That moderate growth in income, this is on a risk basis. The risk there, or the standard deviation, was 14.4. The moderate growth in income portfolio was 9.3, about a third less risk. So if we combine the two, we're getting better return for less risk. That's what we want to do with our clients. And if we put that on, going back to that one chart of risk versus return, we want to be up here in Oregon and Seattle. Here's that 4 asset class portfolio doing that, and here's all of our other asset classes we use. And combining that really helps us bring that type of portfolio to our clients. And let me end up before questions. I certainly want to leave some time for questions. This is another reason clients don't do very well when they bring too much emotion into the market. Eric talked about you have to think about investing with your head, not your heart. We went back to a very long time frame, 1989 to 2016, and we looked at what happens if you would have remained fully invested, what happens if you missed just the 10 best days, 20 days, 30 days, 40 days, and 50 days. Now I got bored on an airplane one time and I tried to count how many days there were. So there were about 6,180 trading days in this time frame, give or take some. I maybe have not gotten some holidays and so forth. But if you would have stayed fully invested, you would have compounded your money at about 7.75%. If you would have missed just the best 40 days, so that's 40 out of 6,180, I don't know what that percentage is, we'll call it very, very low, you might as well have been in a money market fund. So all the return in these risky asset classes comes in a very short period of time. When that time comes, it's really hard to predict that. And when you read, or when you look at CNBC, when you look at Fox News and so forth, most of the conversation is what the market's going to do. Nobody knows what the market's going to do. But what Eric said is you want to be the house. You want to pull that lever knowing that if you get enough pulls, it's in your favor. So let's put it out for questions. I want to end with one of my favorite quotes, is that attention is the rarest and purest form of generosity, and I want to thank everybody for coming and thank you for your generosity. We really appreciate your business and coming in and talking to Wells Fargo. So what questions do you have? What can we answer? I have the
Hey Mike, great job.